The bad years, the crisis years, the Dow dropped by about 50%. And since then, and people panicked and got out, of course, even in the mutual fund business, and particularly in the ETF business, a lot of net liquidations at the lows. And now we're back. I think the gain from that level is maybe 200%. So it shows you that when you act on the emotions of the marketplace, you're making a big mistake. I stay and always have said, stay the course. Don't let these changes in the market, even a big one, that was a 50% decline. Don't let that change your mind. And never, never, never be in or out of the market. Always be in at a certain level. You may want to be 50% in the stocks like I am. You may want to be 75% or 25%. That's probably a decent range. But never be out and think you can get back in, because your emotions will defeat you totally.
One of my favorite Jack Bogle lines is when somebody says buy and hold is dead, or when they ask you, is buy and hold dead, what do you say? You always say, depends on what you buy, right?
Well, yeah, buy and hold for a stock is one thing. Buy and hold the U.S. stock market is quite a different one. What do we have going for us in the U.S. stock market? Leave aside how hard it is to pick the winners. How few people really ever heard of Amazon 25 years ago. To say nothing of Google, maybe a little more than that, maybe 30 years ago. So if you hold the stock market, you will, not to be corny, Bill, but you will grow with America. The correlation between the long-term growth of America's gross domestic product, so-called GDP, and the stock market is something like 95. But the annual correlation of those two things is probably 20. So, you're making a good long-term bet, but short-term betting is just not a good way to go.